Welcome, guys. If you are trying to understand beta, and if you have come across the words like beta in stock market, beta in investments, you've landed on the right video. Now, in this video, I will walk you through the basics and give you the entire concepts, and then we'll tell you how the beta is computed. So, without wasting time, let's quickly look at the agenda for this video. As I said, we'll start with basics, right? I'll talk about what is beta, and then we'll see where all beta can be used and the different types of risk that beta takes into consideration when we compute beta and what are the numerical values that a beta has and interpreting the numerical values and trying to understand what does it mean when beta is equal to 1, so on and so forth. Okay, and finally we'll talk about the certain myths and facts for beta. And one of the things that you see on the screen is where you can get the beta value for a stock. It's simple. I'll give you the answer right away. Just Google what's the beta value of a stock, you'll get the answer. If you type in beta value for Apple, it'll tell you the value for the Apple company. Okay. So finally, I will be sharing this presentation with you. You can find the link in the description. You can use it for your personal use. Before you use it, it's really important for you to understand the concepts so that when you refer to the presentation later on, it becomes easy and you can understand the context in which a particular point is written on the screen. Okay. Beta is nothing but, so let's say you have your investment, right? Let's say you are investing in a company. Okay. Now, you need to understand how your investments will perform, right? Now, if you have to understand the performance, you have to compare against something, right? For example, if the economy is really doing very well, if company is doing really very well, how will your investment will perform against the market? For example, if the market conditions aren't good, then how will your investment will perform? So it's the comparison that you have to do for your investment. Now, how do you do that? That's where beta comes into picture. Okay. It's a relationship measurement. Okay. For with investment with market, overall market, not with any other company. Well, you can do it, but it's generally done with overall market. Okay. So beta is just not about stocks as many people understand. Okay. Beta is about investment. You can have your investment in the stock or you can have your investment in the company. Okay. So beta is used either in stocks or either in company. Since most of the people do investments in stock, that's where beta in stocks, the word has taken popularity, but it can be used for our investments. Okay. So that's what about beta is in simple terms. Okay. It basically gives you the numerical value with which you can compute how much your investment can go up when the market conditions are good, how much your investments can come down if the market conditions are not so good. In this video, I will take stock market as an example to explain it better. Okay, but the concepts will still apply to any other investment. Okay, so let's understand who all use beta. Okay, where all it can be used. Okay, you must be seeing here something like WAC, asset pricing model, and things like that, right? This is what I'm going to explain it to you, how beta is useful and why really beta is needed. Okay. So guys, let me start from here. Okay. You see something called capital budgeting here, right? I made a video on capital budgeting, which was hugely successful. It basically talks about, when you are presented with two different options for your investment, where should you invest? Let's say you have company A and company B, and you have to invest in one company, where should you invest? Now, that was a hugely successful video. In that video, I spoke about how you can wisely invest in a particular company where you can get maximum returns. And in that video, one of the concepts was about discounted cash flow. Now, most of the people have come back and asked me, how would you get the discounted cash flow number? Is it interest rate or is it inflation? How are you getting this number? Now, it's actually not interest rate or inflation. While it can be, but most of the times it's going to be something called WACC, which is weighted average cost of capital. Okay. Now I started making video on WACC. Then I realized I really need to explain asset pricing models for people to understand WACC better. And then I started making videos on different pricing models. Then I realized I really need to explain beta, because without beta, I cannot compute any of these pricing models. And without pricing models, I cannot compute WACC. And without WACC, we will not know discounted cash flow. Without discounted cash flow, we will not get capital budgeting techniques. Without capital budgeting techniques, we will not know how to make our investment wisely in the companies or in the different options we have. So you understand how beta is important, right? Beta is linked to so many things. All right. So this is just for your information where all beta, why beta is important and where it can be used. Let me also tell you what are the different industries or domains within corporate finance where beta is used. Okay. Beta is majorly used in investment banking. Okay. Because these guys do a lot of valuations for the company. And for the valuations of the company, they really need to understand what is beta. Research guys uses beta. They need beta values to compute their, come up with the research details. Trading services, they need to invest money in stock, so they really need to understand beta. Asset management guys, they really need to understand beta because they do a lot of equity management. They have to invest in stocks. Without beta, they wouldn't be able to come up with selection of the stocks. So likewise, they do it in private equity, portfolio research. And here, for example, if you're working for a company, right? If your company is trying to acquire different companies through M&A, which is mergers and acquisitions, they have to do valuations for the company, and they also use beta values for the company. Okay. So there are many places where beta can be used. It's just not limited to these areas, but primarily in corporate finance, you can say these are the areas where beta can be used. Okay. So now we have understand what is beta. Now we understand where beta can be used. Let's try and understand how we compute the beta value. Okay. Before we understand how to compute beta values, right, we really need to understand few concepts with which we'll get to know how the beta is computed, right? You need to understand what is going on in the background when we are computing beta, right? Beta, as I said, it gives you the information how your investment will perform against market conditions, right? Now, when we talk about market conditions, right, what we are talking about is the risk. Okay, basically, what we are just trying to do is we're just trying to assess how much risk do we have for our investment, right? Now, in general, there are two types of risks that we take into consideration for our investment. One is systematic risks, one is unsystematic risks. When we say systematic risk, we're talking about macroeconomic factors. Okay, what is macro? Macro is something outside the control of a company. Okay, outside the control of a company. Well, company can be doing really very good. Okay, they have top management, the sales are very good, and everything's going fine for the company. But what about the outside factors? Let's say the political, or there is a lot of inflation or deflation going on in the company wherein people do not have money to buy the products. Well, company is doing very good, but it also depends on the outside factors, right? Now, these are the factors which are taken into consideration for systematic risk. Okay, this is a risk that the entire system is presenting for the companies. That is why it is called systematic risk. And system risks are outside the control of the company. And unsystematic risks are something which a company can control. These are micro. These are within the company. For example, if your company finances are not being managed well, right? If your company is earning profits, but if the company is doing investment here and there without proper debt or without proper, whatever the reason it could be, okay? If it is not being managed well, this is something within the control of the company, and these things can be fixed. Now, when we try to compute beta, right, we only take into consideration the systematic risk, not the unsystematic risk. Okay, there is one important thing I just want to tell. Okay, most people will say, okay, we only take into consideration systematic risk for beta, but that's not entirely true. I'll tell you why. Before even picking up a stock, there is something called fundamental analysis. Okay, In fundamental analysis, people will look how the company has been performing for the last previous years, okay, how the management is there and things like that. Now, what the investors usually do is the top-notch investors, they have a list of companies which are fundamentally strong companies, okay, which are fundamentally strong companies. That is where they put the money in. They don't pick any stock randomly and then they try to compute beta and invest money. They first have the list of companies which are fundamentally strong companies, and out of fundamentally strong companies, that is where they use systematic risk. Okay, so when we say beta does not take into consideration the unsystematic risk, it means because we already are working on fundamentally strong companies, not the companies which are having unsystematic risk. Okay, so anytime my suggestion or my advice is you try to invest money in a stock, go with fundamentally strong companies. And just choosing a fundamentally strong company isn't enough. You really need to understand the valuation for the company. And for you to come up with the valuation of the company, you need to know beta. Okay. Uh, so that's about the systematic and unsystematic risk at the high level. Okay. What we are basically saying is we just deal with the systems risk. Okay. We take this risk into consideration and then we'll see how our investment will perform. All right, now let's see how we can use beta to assess our investment. As I was saying, we are comparing our stock with the stock market, right? Because we're comparing two things should also have some number. Okay, one of the numbers is variable. For example, any stock's beta value is going to be a variable number. It can change over a period of time. But since we're comparing it against the overall market's base value should remain constant. Stock market's beta value is given as 1 and it's going to remain constant. And against this constant number, we're going to compare how our stock is going to perform. On the screen, you see the beta values for Apple, Google, and Microsoft, right? These beta values are something that you can just do Google and then you can get the numbers. We're really not computing the beta numbers. If you say what we're doing is we're using beta numbers to assess our investment. Okay. I'm using Apple, Google, and Microsoft as an example just to give you an understanding how you need to assess. Okay. It's just basic maths. What you see here is S&P is having a beta value of 1, Apple is having 1.21. So 1.21 is greater than 1, right? Which means if the stock market is going up, Apple will go little more up, okay, than whatever it is. And if it is coming down, stock market, then it will also go down by that proportion. Now, if I have to convert these numbers, right? If S&P is going, let's say, up by 100%, since the Apple stock has a beta value of 1.21, this particular stock is going up by 120%, 21%. Okay. Now, if the overall market is coming down, let's say by 50%, now how much should the Apple stock be coming down? 5 into 1.21, right? So Apple stock would be coming down by 60.5%. Okay. So that's how it works. Okay. Now, if I take the same example for Google, right? Now, if the market is going up by 100%, Google stock will go up by 110%. And similarly, if the market is coming down by 50%, Google stock will come down by 50%. And Microsoft is 0.93, which means if the market is going up by 100%, Microsoft will go up by 93%. And if the market is coming down by, let's say, 50%, now this is going to come down by, let's say, 46% around. You see, having a high beta value is good, but there are risks associated with it. Okay. When the market is bullish, the stock will jump really high. When the market is bearish, the stock is going to also fall really high. And if you look at Google, right now it's 1.1. Now, if you take any other stock, for example, which is 1.01 or 1.02, which is having a beta value of 1.01, which is close to 1, right? That means that particular stock is going to behave as per the market. If the market is raising up by 5% in a day, that stock is gonna raise by 5% in a day. Okay. Similarly, if the stock is going to go down by 10%, the overall stock market, then the stock is going to go down by 10%. Whereas these stocks with high beta values, when the market goes up, they really jump high. When the market comes down, they really jump down. So I hope you got the concept. Okay. What we are really going to look into is try and understand by looking at this real graph. Okay. I pulled this graph from, TradingView. The one that you see here, this one is S&P. Okay. The one in white is Google. This one is Google. The one in orange, this one is Apple. The one in yellow is Microsoft. Okay. Now let's look at this one. Okay. The blue graph. Do you see the yellow one, the Microsoft one is, is also following the pattern? Just take a look at it. Okay. How much of the market goes up, Microsoft is going up. How much of the market is going down, it's coming little down. You see, Microsoft is 0.93, correct? Now, market has come down by, let's say, whatever the points, okay? But Microsoft has fallen little. Okay, so it is showing resistance because we have 0.93 for Microsoft. It's showing resistance even when the market is going down. Microsoft doesn't fall much. Take a look at Apple. When the market is coming down, right? Apple is really going down. When the market is going up, you see this here, Apple is jumping up. But when the market is coming down, you see the fall, it's high. Okay, when the market is coming down, the fall is high. When the market goes up, it really goes up. You see it here. You see how much is this jump? A little, right? But look at this jump here, right? But look at this downfall here. Okay, look at the size, but look at this size. So this is what I'm just trying to explain, right? With beta, you have risks and you have advantages as well. Okay, so you have pros and cons. If the beta value is greater than 1, the market really jumps up, and the stock really jumps up and the market goes up, and the stock also really falls down and the market goes down. Okay, but having a beta value of 1 is as good as you're investing in the index stock. Okay, because okay, if the index is going by 100% and the stock is also going by 100%, then it's as equal to as investing in the index stock. Okay, there may be other benefits, like you may begin getting dividends for investing in the stock, but that's what the point is. So let's look at the interpretations for beta. As I was just saying, high beta stocks with greater than 1, there are certain pros. When the market is bull market, the stocks really jumps high. So what's the lesson here for us? When you observe that there is a bull market coming in, you should always be invested in beta stocks which are greater than 1. But also you need to be cautious, because when the market really goes up, you should take your profits out of it. And because when the markets come down, the beta stocks with greater than 1 are going to fall really down. Okay, just exercise that caution. That's what you are learning as a lesson from this video. When the market is bullish, make sure you are investing in beta stocks which are greater than 1. Similarly, beta stocks with neutral 1 or close to 1, they move as the market moves, as if you're invested in the beta, as if you're invested in the index itself. See, one thing I just want to make it very clear: investing in a stock which has a beta value of 1 doesn't mean that you are not taking the risk at all. You still have to deal with the market risk. If the overall stock market is coming down, you are going to see that the stock is also falling down, but to the extent that the market is going to come down. Okay. In the recent times, you have observed that the stock markets overall has fallen down, right? Now you can see that Microsoft might have fallen little down and the rest of the stocks may have fallen more, depending upon the beta value. Okay, but there is still a risk even in the stocks which has a beta value of 1. Those are the overall market risks. Beta value of less than 1, okay, when the market really goes up, they jump a little. When the market really comes down, they also fall a little. Okay, these are safer bets. People with risk averse attitude, they can go with low beta stocks. Okay, what about zero beta? We've spoken about beta greater than 1, beta less than 1, but we haven't spoken about stocks which has a beta value of 0. In simple terms, in one word, if a stock has a beta value of 0, it means that there is no relationship between the stock and the stock market. And I really doubt whether such a stock exists. Okay, maybe it is like you're holding the cash, putting the cash on the exchange and waiting to see where the market goes up and down. At which point in time, there is no relation, right? Even if the market goes up or down, you're gonna remain with the same cash that you have put into the exchange. Okay, so as a pro, there is zero risk. But what is a con? Maybe if you have kept your money in the exchange without investing in any of the stocks, you still have to deal with inflation. Okay, and what about the stocks with beta less than 0 or close to -1? It means that these stocks are performing opposite to the stock market. Let's say the overall stock market is coming down, these stocks may be going up. And if the stock market is going up, these stocks may be coming down. In general, people say gold is such an asset. When the stock markets come down, gold picks up. But when the stock market is really going up, gold will fall down. Maybe there is a little similarity, or maybe there is a fact in it. But yeah, gold can act as a hedge when the markets are really coming down. And if you see that a particular stock is acting against the overall market, it's a possibility that it's a temporary phenomena because of some good news in that particular company that is taking the stock up. But that's going to remain temporarily that way. If the market is moving in downward trend for a couple of months, that particular news that the company might have gotten would be for temporary period. But I could be wrong, but in general, that's the case. It is also possible that you're getting trapped into stock manipulations by big whales, okay, or by institutional investors, okay. If they really want to dump a stock onto you, first maybe they will go against the market. If the market is going up, they may sell it. If the market is going down, they may buy it just to put you into the trap, saying that, you know what, investing in this stock is going to make you money. Okay, so that's about less than zero beta stocks. Some facts and myths about beta is beta cannot accurately predict the stock price movements. Okay, it cannot accurately predict. If that is the case, everyone would be a stock market investor. Okay, however, it still is taken into consideration because it's popular amongst the investment banking professionals, because it will at least tell you the pattern in which the stock is going to behave. Okay, but it's not an absolute measure to know how much return you would get as per the market movement. Okay, I just present you some summary. Okay, so that's about beta. You can find the link for this PPT in the description below. And if you have any questions, please feel free to let me know in the comment section. I'll try and respond to your comments. Thank you.